one of the most important things for any firm of accountants is to make sure that they are up to date. This allows them to make sure everything they're filing is correct, of course, but also it means that the advice they give to clients can be as accurate as we can possibly get it, as soon as it is possible to give that advice. And that's why I'm delighted to be joined by Owen Kyffin, who's one of the directors at Whitley Stimpson, and he's going to helpfully tell us a little bit about the bits and pieces that Mr. Hammond has said in his first autumn statement, and potentially his last autumn statement as well, of course. He's decided to change the structure around. One of the first things I wanted to ask you about, he's announced that corporation tax rates are going to continue to fall. I think we're at 20% at the moment, and he's looking at lower figures than that. And I mean, I guess low tax rates, good news for all the clients.
Yes, well, it's got to be really, especially those trading via a company. And it's been the case for some time that we do have to look at our clients to see whether a company is the best format for them to trade from. And with the continuing downward direction in terms of corporation tax rates, 17% and maybe even lower, it is something that's worth considering for unincorporated businesses.
Okay, and as you say, it's 20 now. We're looking at 19 from, I think, April 17, and then it stays at that for a while, but by the end of this Parliament, we're looking at 17.
17%, yes, indeed.
Right. And then, compared to other countries, that's
really low, yes. We're heading towards being a low tax haven almost.
Right. And so we are looking at a situation where the option to incorporate is still there. We should still look at that.
Yes, it is still there. It's obviously less attractive in some regards, as we've lost the Entrepreneurs Relief Fund Incorporating Goodwill, which was a low blow for us, really. But yes, it's still something that businesses should look at. But you do really need to crunch the numbers. Dividend rates have increased to 7.5% and 32.5%, as opposed to 0% if you're a basic rate taxpayer, and then an effective rate of 25%. So the attractions have been whittled away a little, but in the majority of cases, there's still a saving to be had. As I say, though, you do need to crunch the numbers, and you do need to talk it through in detail with the client, because for some people, they simply don't want the hassle of running a corporate body.
And then there are other things we can look at deducting before calculating our profit, actually, whether we are a sole trader, a partnership, a company, whatever it may be. And I'm struck by the annual investment allowance, a fantastic relief. I can spend quite a lot of money and be able just to deduct that straight off my computation for the year. But actually, it's not as straightforward as just buy something, deduct it, is it?
No, absolutely not. Capital allowances must be one of the most complex areas of taxation. If you're buying a simple big bit of kit with a big spend, that's easy. You will normally just dump it into the annual investment allowance and write off against tax the total cost in year one, provided it's below the £200,000 limit. But where you're doing a big refurb, for example, on an office block that you're trading from, or some factory premises that you're trading from, it's far more complicated than that. You have to look at the whole integral features rules, which reduces the rate at which you can claim your capital expenditure if you've used your annual investment allowance already. But you also have to look then at the tax-favoured bits of kit that you can put in a new factory or a new office, such as energy-efficient plant and machinery. And of course, the new feature that was introduced in the autumn statement, which is the 100% allowance for charging points for electric vehicles. And that gives you scope to use the 200,000 elsewhere if you have a big project on.
Okay, and you mentioned the idea of an office refurbishment, things like that. So presumably people who are owning large buildings, looking after large buildings, it could well be that by talking it through, they could get £200,000 in one particular place, plus the integral features could be a different rule, the environmentally friendly assets another one, and on top of that, these new deductions as well.
Absolutely, and the earlier they talk to their accountants, the better, because if we can get involved at the pre-build stage, we can get input from their QSs and from their building contractors to make sure we've got the data that we need to maximise any capital allowances claim.
Right, so huge potential at the moment to have a look at that, particularly if you are looking to spend some money. Probably the biggest talking point as far as the general public were concerned from the autumn statement was this thing to do with salary sacrifice. Now, salary sacrifice, very well known idea. Rather than taking pay and then have to pay tax on it, I will get my employer to buy me the thing I want instead. So rather than having £500-600 salary, I might sacrifice that and have a brand new iPhone from my employer instead. And of course the benefit of that is that rather than having to buy the iPhone out of my net pay, so having to pay tax, the benefit on the phone itself is exempt and therefore no tax at all. But he's looking to stop us doing that.
Absolutely. There are a couple of things you typically see salary sacrifice used for. Either you sacrifice part of your salary in exchange for a tax-free benefit, for example, the phone in your example, or childcare vouchers, which saves you the tax and both you and your employer the national insurance contributions. Or alternatively, you sacrifice it for something that's still taxable, but there's a potential NI saving there. Well, clearly this has come onto their radar and they seem to be wanting to tighten up the rules there and make it a bit harder for us. But they are protecting some of the very commonly used tax-free sacrifices. So we know that pensions are going to be safe in terms of salary sacrificing for additional pension contributions, as are cycle to work schemes, childcare vouchers.
Okay. And so a lot of people are involved in this with relatively large assets, actually, particularly in their own businesses. You might see somebody salary sacrificing and taking a car instead. And some people in depends on your family's income, I guess, but some people will sacrifice almost their entire salary in exchange for benefits where there is an advantage from the company buying it rather than the individual. But then some people, of course, will just earn a fairly low salary and be able to add things on that they fancy if they own their own company. So it's not going to be as straightforward as everybody with a salary sacrifice is caught unless you're in one of the exempt areas.
No, and there's more than one way to crack an egg. So, for example, you could maybe forego future pay rises in exchange for certain benefits. It's also complex in as much as there are a number of exemptions from the immediate withdrawal of the benefits, and those are being phased in over a number of years. So if you can arrange your affairs so that rather than sacrificing salary, you're simply having your employer provide you with an additional benefit, which obviously if it's your own company is eminently doable, which has a tax-favoured treatment in some way, for example, an electric car, it can still be a very effective and attractive route to go down.
Okay. And so what we're learning as we sit here talking is that probably the three largest direct tax changes from the autumn statement, the introduction of the capital allowances potentially, the further cuts in corporation tax, and also this salary sacrifice point, the message seems to be the sooner that you can get sorted on this and understand exactly what your position is, the better. We need to make sure we get advice pretty quickly.
Indeed, and especially if you're running an existing salary sacrifice scheme, you do need to look at what the impact of these changes are on that to see whether you need to do something to make sure your employees aren't disadvantaged.
Okay, and then one final area I'd like to talk about, we move away from direct taxes into VAT. And a scheme that we've had for quite a few years now, which has simplified VAT massively for a very large number of small businesses. A very generous regime, which we always have said was very generous.
Yeah,
it wasn't that we thought, oh, it's generous, let's get it while we can. We just thought it was meant to be generous.
Yeah.
The flat rate scheme for VAT, a very simple idea in itself. Rather than say I've charged VAT to my clients and I've recouped the VAT from people I've bought from, we simply don't have to worry about the VAT we've paid ourselves, and we have to charge 20%, but a pre-agreed figure for our industry type is the figure we will then use to decide what to pay to the revenue. So it could be that we've charged everybody 20% on top, but the revenue have said, because you are a, whatever it may be, management consultant, we only want 14.5% from you. But they're not happy with how we're using this scheme.
No, the argument is that it's been misused and abused, but I'm not really sure I buy that because, after all, it was the relevant Treasury departments that wrote the rules for it. We've used it extensively. Yes, our clients do get a margin from it and there can be a tax benefit to it, but the biggest advantage of it is that it's a much simpler scheme to operate, which means it's much easier for HMRC as well, because it's much easier to check and it's much easier for them to administer.
And so the change he's announced is that, I mean, the problem they had was that if you introduce this 14.5% figure, that's the average point, I guess, for any management consultant. If you spend more than that, than the average person, you need to go on proper VAT, if you like, because that way you can reclaim all of your extra costs. But if you're below that figure, if you spend less than the average person, the flat rate schemes almost certainly a no-brainer. Is that fair to say?
Yes, it certainly was in the past, and to be honest, that's exactly why the margin was there, to encourage people to use a simpler scheme.
But unfortunately, from I think April next year, he's introduced this new percentage figure, which doesn't matter what industry you're in, 16.5%.
Yeah.
If you are somebody who has very low costs.
Exactly, which, as we were discussing earlier, that almost brings you back up to the 20% normal rate once you've accounted for the fact that you're paying it on your gross receipts, your VAT inclusive receipts.
Yeah, so if you've charged somebody £100, you'll actually have charged them £100 plus 20 for VAT, and this 16.5% we have to pay isn't on the 100, it's on the 120.
Exactly.
And so actually that's 19.8% VAT anyway.
So in some senses, there's very little point having the flat rate scheme anymore, other than it's simpler to use.
Okay, but for some people, they will still be allowed to use their old numbers, their 14.5s and 12s and what have you. So again, it sounds like we're back to the same old message, which is we need to look at this.
We need to talk to someone, yes.
Okay, well, thank you very much, Owen. Do remember, you can get in touch with Owen and the team at Whitley Stimpson using the details to follow.